Hello humans, welcome back to Finance 14. This particular video is unique because I will be discussing the top 5 crucial factors that numerous investors considered before making any investment. As an investor, it is important to know the financial health of a company before investing your hard-earned money. Also, a quick disclaimer before we begin. The information provided in this video should not be considered as an investment advice. It is highly recommended that you seek guidance from a professional financial advisor prior to making any investment. Okay, let's get the video started. Measuring the profitability of a company before investing is crucial because it helps investors to make informed decisions and minimize their risks. Here are some reasons why profitability measurement is important for investment decision making. First, evaluate financial health. Measuring profitability provides insights into a company's financial health. Investors can assess a company's ability to generate profits consistently, manage expenses, and sustain long-term growth. Second, assess growth potential. A profitable company has the potential to grow and increase its market share. By evaluating profitability metrics, investors can gauge the company's growth prospects, which is a critical factor when considering long-term investment decisions. Third, compare performance. Profitability metrics can help investors to compare the financial performance of the company in the same industry. This helps investors to identify the most profitable companies and make informed investment decisions. Fourth, determine valuations. Profitability metrics can also help investors to determine a company's valuation. A company with a strong profitability metrics is likely to have a higher valuation, while a company with a weak profitability metrics may be undervalued. Fifth, manage risks. Investing in a profitable company reduces the risk of losing money. Profitability metrics provide valuable insights into a company's financial health, which is a critical factor in mitigating investment risks. There are several key parameters that are commonly used to measure the profitability of a company. Let's take a closer look at the 5 most important parameters. First, net profit margin. Net profit margin is financial metrics that indicates a percentage of a company's revenue that turns into net income or profit after deducting all the expenses, including taxes and interest payments. It is calculated by dividing the net income by the total revenue, expressing the result as a percentage. Investors and analysts use net profit margin as an important indicator of a company's profitability and operational efficiency. A higher net profit margin indicates that a company is able to generate more profit from its sales and has better cost management practices. A lower net profit margin indicates that the company may be facing some challenges in generating profit or managing its expenses. It's worth noting that the net profit margin can vary significantly between companies and industries, and it is important to compare it with other companies in the same industry to get a better understanding of a company's performance. Second, return on equity, that is ROE. Return on equity is a financial metric used to measure the profitability of a company by evaluating its ability to generate profit from the shareholders' investments. It is calculated by dividing the company's net income by its shareholders' equity. Investors use ROE as one of the metrics to evaluate a company's financial health and its potential for growth. In general, a higher ROE indicates that a company is generating higher profits from its shareholders' investments, and it is considered a positive sign for investors. However, it is essential to evaluate ROE in conjunction with other financial metrics to have a more comprehensive understanding of a company's financial position. Third, return on capital employed, that is ROCE. Return on capital employed is financial ratio that measures a company's profitability and efficiency in utilizing its capital investments. It is an important metric used by investors and analysts to evaluate a company's financial performance. ROCE is calculated by dividing a company's earnings before interest and tax by its total capital employed. Total capital employed includes all of the company's long-term debt and equity capital, as well as any short-term debt used for long-term purposes. ROCE is a useful ratio to compare the financial performance of a company within the same industry or sector. Higher ROCE is generally better as it indicates that the company is generating higher returns on its investment. However, it is important to consider other factors such as company's debt levels, market competition, and economic conditions when interpreting ROCE results. Fourth, cash flow margin. Cash flow margin is a financial metric that measures a company's ability to generate cash from its operations relative to its revenue. Specifically, cash flow margin represents the percentage of a company's revenue that is converted into cash flow from operations. To calculate the cash flow margin, you need to divide the company's cash flow from operations by its total revenue and multiply the result by 100. A higher cash flow margin indicates that the company is generating more cash from its sales, which can be used to fund its operations, invest in growth opportunities, and pay dividends to shareholders. Fifth, earning per share, that is EPS, which is a financial ratio that measures the amount of profit earned by company on per share basis. The formula for calculating earning per share is EPS equals to net income minus preferred dividend divided by average outstanding shares, where net income is the company's total income after deducting all the expenses and taxes. Preferred dividends are the dividends paid to preferred stockholders which are subtracted from the net income before calculating EPS. Average outstanding shares are the average number of common shares outstanding during the period. EPS is an important metric that is used by investors to evaluate a company's profitability and to compare it with other companies in the same industry. A higher EPS indicates that the company is earning more profit per share, which can make it more attractive to investors. Analyzing these parameters will give you a better understanding of a company's profitability, financial health, and potential for growth. So, make sure to take the time to analyze these parameters before investing in any companies. And that's it for today's video on why it's important to analyze the profitability of a company before investing. We hope you found this information helpful, and if you have any questions, please let us know in the comment section below. And don't forget to like, share and subscribe to our channel for more financial insights and analysis. Thanks for watching. We'll see you in the next video.